No rate hike. That's the message from the Federal Reserve's January statement, though not much commentary on the state of the markets, which have been incredibly volatile in recent weeks. For more analysis, Nick Kolas, the chief market strategist at Convergex, joins me now on set. And Nick, it's nice to see you. Welcome back.
Great to be here.
So no rate hike, no surprise there. But do you think the Fed is pulling back a little bit from its forecast back in December of 4 rate hikes in 2016?
It certainly does seem that way. This did not read like a Fed that is ready to pull the trigger anytime soon. And with 4 rate hikes on the dot plot for in December, we'd have to start seeing some visibility this quarter. It just isn't there.
And the S&P 500 is down, what, 7% so far this year? So it's been a very volatile time. Here's what the Fed said about the markets. Let's put up this full screen. The committee is closely monitoring global economic and financial developments and is assessing their implications for the labor market and inflation and for the balance of risks to the outlook. So not much telling as to what's going through the Fed's mind when it comes to the markets.
No, it's very true. It's almost like the Fed is as much in the dark as the markets are right now, and they see the push and pull of some still decent growth in the U.S. potentially combined with its pressures overseas, and they don't know what to make of it either.
So as we look towards the next meeting in March, I mean, is that when we'll see the next rate hike or perhaps sometime after that?
Well, I'll tell you, the Fed funds futures market, which has been very prescient for the last 2 years at calling these moves, says it's a 50-50 shot through July of this year and only about a 75% shot that we even get one increase by the end of December. So the market's saying the Fed's going to be a lot slower than the Fed has told us they'll be.
But on that note, I mean, if the Fed wanted to raise rates 4 times this year, they could. I mean, we're only 1 month into the year.
That's absolutely right. We shouldn't make too much of this 1 month, as hairy as it's been. And the Fed is trying very hard not to get suckered in by all the market volatility the way it did back in September when it held off raising rates in September because of the China volatility in August.
Now, will this statement perhaps provide the stabilization that the markets need, or are we going to go back to obsessing about oil?
You know, unfortunately, it seems like the Fed didn't give us very much today. And we're going to go back to those old tells about where is oil, where's the 10-year, where are rates, and the market will continue to have this kind of high volatility churn.
Now, one thing in this statement, the Fed didn't say that it's reasonably confident that inflation will move back towards its 2% target, yet in December it had that reasonably confident phrase. What do you make of that difference?
It feels very much like a response to oil prices in the near term, because even though inflation isn't driven ultimately by just one commodity, it is a very important component. The Fed seems to be saying that that piece of the equation might be further off than they thought previously.
So does this change your asset allocation strategy? Is there anything different going through your mind now?
No, not really. I can tell you that our clients are looking to potentially find a bottom near term. That's what we've heard a lot of recently. So there's no reason to sell if you haven't done so already. And if you're interested in looking at equities, now's the time to start nibbling, it seems.
All right, Nick, we'll leave it there. Nick Kolas, the chief market strategist at Convergex. Thanks very much for joining us on Fed Day.
Thank you.
I'm Scott Gamm, and you're watching The Street.